the domestic markets. It's among the first foreign banks to get coveted membership in the Shanghai Gold Exchange. Others said to be about to get the nod include UBS, Societe Generale, Bank of Nova Scotia from my home country, Canada, and Standard Bank of South Africa. Jörg Keener, Chief Investment Officer at Swiss Asia Capital, joins us from the Lion City this morning. Jörg, good morning to you. HSBC happy that they're getting into the Shanghai Gold Club. What does this mean for global gold markets? Any implications about this startup in Shanghai?
I think what we start to see is a wider distribution of gold in China. After having liberalized the gold distribution a couple of years ago through the local banks, we get now as well foreign banks. And it's basically distributing the increased output in China and keeps it inside the country.
How big a player is China and the central bank in the gold market? Because central bank selling momentum has certainly been an issue in the precious metal space.
If you look at China as a producer, it's probably the fifth largest producer in the world. If you look at China as a central bank, it's one of the smallest players in the world. I think they have less than about 1.5% gold cover versus total reserves. And rebuilding that portion of gold in the central banking system is probably taking place as we speak.
Okay, what's going on with gold, silver, and other precious metals classes? We got this specter of higher interest rates seems to be item number one in everybody's mind right now. Gold lost $10, $11 per troy ounce. Is the party over, Jörg?
I think it's a fantastic buying opportunity to dip, and the main reason is the correlation of higher gold prices to higher yields, particularly in subprime and high credit risk, is key. This correlation is much bigger than the correlation with commodities. So what we've got to see is that the bond markets just broke out of a 27-year bull market into a bear market, and with inflation basically being rampant around the world and money supply growth being basically in the 20% range per annum, it basically will fuel further interest rates, and thus this perception becomes common knowledge in the market that will force higher yields. And with that, I think we're going to see massively higher precious metal prices in the months to come.
We're getting a certain chatter in the market that more and more of the gold players are going to be closing their hedge books because they don't really like the idea of selling forward, only to find that the spot price is higher, and then they're kind of caught on the short end. I think the latest talk is Newcrest in Australia going to go ahead and start closing their forward books as well. Is this the indication you're getting?
I think if you look over the last couple of months, we had at least 4 mines which closed the hedge book, some of them with share offering like Italy here. We had Barrick, we had some Newmont closing, we had Buenaventura. So I think this trend is going to continue, and the main reason is if you look at the base metals, they've all been gapping up over the last 2 years, where prices basically 4, 5, 6-folded in a very short period. And I think something similar could happen to the precious metal market as the central bank overhang, particularly in the West, is coming to an end, which if you look at the last month, Spain, who's basically technically bankrupt, has been selling over 80 tons of gold into the market. And if you think that gold's been basically stable in that environment, that's a fantastic sign of the physical strength underneath.
España is bankrupt? Not really, right? Just technically.
I mean, yeah, technically. I mean, basically, they only have reserves for 12 days import cover. On 12 days import cover, I probably will not deliver you any goods anymore.
Wow, I had no idea. We better get to Madrid and help them out. You saw that JPM report, JP Morgan saying $1,000 a troy ounce. My eyes kind of popped out when I saw that. What's going to get us from 670 up to 1,000?
I think what you really see is basically the debasement of money globally, which is gathering speed. And I think as you start seeing profit taking in the bubbles around the world, this money will have to reposition itself for the fallout of that, and I think this money will trigger higher price in commodities. Now, 1,500 for JP Morgan as a massive short player in the market is an amazing statement, and shows actually that even the bears are turning bullish. That means basically for any investor, they should start having some exposure to that sector.
Wow, you know, JPM's a major shorter in the market, and yet they put out a piece like that. Is that what you're saying?